Welcome back to the channel, where today we explore Lyft's latest earnings report and the implications of its 12% stock drop. On the surface, such a decline might send investors scrambling, but could it actually present a golden buying opportunity? Lyft's impressive financial growth is hard to ignore, with a major share buyback program and ambitious targets set for 2027, suggesting potential as one of the most undervalued stocks in today's market. In Lyft's Q4 2024 earnings release, we witnessed strong financial performance, showcasing notable year-over-year improvements across various metrics. However, despite these positive numbers, the stock saw a significant drop in after-hours trading, largely attributed to lower-than-expected future guidance. Investors appeared to react to the company's adjusted EBITDA margin for Q1 2025, which didn't meet expectations, creating an opportunity to examine if the reaction was truly justified or simply a reflection of market emotions rather than fundamentals. When we compare Lyft to its major competitor, Uber, it becomes clear that both companies have unique investment potential. While the speaker holds a long-term position in Uber due to its diversified business model spanning food delivery to freight logistics, Lyft's focus solely on ride-sharing in North America positions it differently in terms of risk and reward. This significant contrast means that while Uber may appear safer over the long haul, Lyft could offer a compelling short-term opportunity for growth. Lyft's financials reveal a narrative of resilience and improvement, with gross bookings soaring to $1 billion, total rides reaching 828 million, and active riders growing by 10% year-over-year. The fundamentals demonstrate a company on the rise. Notably, Lyft achieved GAAP profitability for the first time, marking a significant milestone that underscores its fiscal health. Additionally, the increase in free cash flow to a record $766 million serves as testament to strong financial discipline amid industry fluctuations. In summary, investors must weigh the immediate market reactions against Lyft's long-term growth potential. With its intriguing financial performance and projected improvements, is Lyft a hidden gem waiting to be discovered? Or does the recent stock drop indicate deeper issues lurking beneath the surface? As we continue to analyze these elements, stay tuned for more insights and updates, and don't forget to like, subscribe, and keep that notification bell ringing for future stock market explorations. Lyft, a prominent player in the ride-sharing industry, is navigating a path of growth amidst fluctuating market dynamics. Currently valued at $5 billion, the company has caught the attention of investors with its newly announced $500 million share buyback program, allowing for the repurchase of approximately 9% of its outstanding shares. This strategic move signifies Lyft's confidence in its financial health and could potentially benefit long-term shareholders by boosting the stock price as supply diminishes. Despite challenges, the stock's current valuation reflects a deep discount in comparison to its expected growth in cash flow, highlighting a significant opportunity as business fundamentals improve. Looking towards the future, Lyft's projections for Q1 2025 reveal an anticipated gross booking growth of 10 to 14%, estimating figures between $4.05 billion and $4.2 billion. Adjusted EBITDA is expected to be between $90 million and $95 million, reflecting margins of 2.2% to 2.3%. While some investors express concerns regarding the subtle dip in EBITDA compared to previous quarters, it is essential to recognize the seasonal effects influencing these fluctuations. A broader perspective on Lyft's trajectory suggests that investors should prioritize long-term growth potential over transient margin variances, aligning investments with the company's expansion narrative. Lyft is carving out a niche in the future of transportation by integrating autonomous vehicles into its platform. Recent partnerships, such as the collaboration with May Mobility for AV rides in Atlanta, illustrate its commitment to innovation. Additionally, with plans to launch autonomous fleets in Dallas by 2026 in partnership with Marubeni, Lyft has not lost ground to competitors like Waymo in critical regions. Consumer demand remains strong, especially in markets like Phoenix, where growth rates have surpassed national averages. The expectation is that AVs will enhance the ride-sharing experience rather than overshadow Lyft's core services, fostering a dual growth model. The company faces competitive challenges that could shake its market positioning. The imminent end of its partnership with Delta Airlines, as the latter transitions to Uber, may impact Lyft's annual gross bookings, leading to a potential decline of 1 to 2 percentage points. Furthermore, the constant emergence of formidable competitors such as Uber and the ambitions of companies like Tesla in the robo-taxi space add pressure. As economic conditions fluctuate, there lies a risk of reduced discretionary spending on ride-sharing that could dampen demand, alongside the looming threat of government regulations affecting gig worker costs. Despite these obstacles, Lyft is innovatively enhancing its revenue streams through the growth of premium rides and an expanding advertising business, marking a promising avenue for future profitability. Lyft has set ambitious targets for the year 2027, aiming for a remarkable 15% annual growth in gross bookings. This performance goal is buoyed by the expectation that total gross bookings will soar to an impressive $25 billion. Achieving such milestones will also reflect on Lyft's adjusted EBITDA margin, projected to jump to 4%, a significant increase from the current 2.6%. In addition to top-line growth, Lyft is jockeying for improved free cash flow, with projections suggesting a margin increase from 7% to 9%. This positions the company to generate between $900 million and $1 billion in free cash flow. These forecasts suggest a company poised for significant financial upward mobility, reflecting not only on operational improvements, but also on strategic decision-making. From a valuation perspective, Lyft's current trading status raises eyebrows, as it showcases a remarkable undervaluation at just 5 times its expected free cash flow for 2027. Reverse discounted cash flow analysis hints at even brighter horizons. Even if growth stagnated, estimates suggest Lyft's stock should soar a staggering 74% higher than its existing price. Such figures hint that the market remains skeptical of Lyft's true potential. Despite the promising projections, the reality of investments in Lyft comes with considerations of risks. Before the recent earnings slip, Lyft stock was riding high above key moving averages, but a downturn has seen it dip below those critical levels. The implications of this shift may introduce some short-term volatility, posing a cautious outlook for potential investors. For those contemplating investment strategies, it is vital to recognize the balance between short-term potential and long-term growth. While the speaker views Uber as a stronger long-term play, he acknowledges that Lyft may offer an intriguing short-term trading opportunity for those able to embrace volatility. The combination of strong financials, growth prospects, and undervaluation can magnetize contrarian investors poised to leverage 2025 to snag discounted stocks. Finally, the conversation surrounding Lyft extends beyond mere numbers. It embraces the evolving landscape of transportation. As the future of autonomous vehicles unfolds, it is anticipated that Lyft and Uber will not face extinction, but will coalesce within this new paradigm. Regardless of the approach taken, whether it is a sustained hold or quick trade, understanding Lyft's potential within its market context remains key.